Federal Reserve Master Accounts and the Payment System. Updated December 8, 2022. Financial technology, fintech, has introduced substantial innovation in retail payments through both traditional banks and fintech firms. Although fintech firms do not provide traditional banking services, some have pursued and received state or federal bank charters. For payment firms, obtaining a bank charter is often motivated by the desire to access a Federal Reserve Master Account, enabling direct participation in wholesale payment systems and related Fed payment services without the need for an intermediary bank. Cryptocurrency firms with state bank charters have also sought master accounts to facilitate seamless transactions between cryptocurrency and official currency. Traditionally, banks hold most of their reserves in master accounts with the Federal Reserve. These reserves are highly liquid cash balances, unlike funds typically invested in loans or securities. Minimum reserve requirements for banks were in place until 2020, when the Federal Reserve removed them. Master accounts allow for efficient completion of payments between end users, such as customers and merchants using different banks and payment systems, by connecting the accounts at the Federal Reserve. Banks aggregate and net customer payments, then use wholesale payment systems to debit and credit each other's master accounts, where transactions are cleared and settled. Institutions seeking master accounts must apply to the Federal Reserve. While applications from traditional banks are generally approved promptly, non-traditional applicants, such as fintech firms and cryptocurrency institutions, have reportedly experienced delays, which has led to concerns. The increase in non-traditional applicants has raised important policy questions, including who should be eligible for master accounts under current law, how transparent the application process should be, and what safeguards the Federal Reserve should impose on firms with master accounts. Two cases exemplify this debate: the application by Reserve Trust, a fintech company with a state trust bank charter, which was discussed at a Federal Reserve nominees confirmation hearing, and Custodia Bank, a Wyoming state-chartered bank specializing in cryptocurrency, which sued the Federal Reserve over delays in its master account application submitted in October 2020. Other high-profile applications include those from public banks, narrow banks, and banks providing services to cannabis businesses. Federal Reserve guidance and legislative context. In August 2022, the Federal Reserve issued final guidance through a notice and comment process detailing how it would evaluate master account applications. The guidance aimed to make the process more transparent and ensure consistent treatment for non-traditional institutions across the 12 regional Federal Reserve banks, each of which independently decides on applications within its district. According to the final guidance, the Federal Reserve may grant master accounts only to entities meeting the statutory definition of a member bank or depository institution, including designated financial market utilities, certain government-sponsored enterprises, the U.S. Treasury, and specific official international organizations. Eligible institutions must comply with laws and regulatory requirements related to payments, anti-money laundering, sanctions, and risk management. They must also demonstrate financial health and pose no risk to the Federal Reserve or financial stability. Assuming eligibility, the Federal Reserve's final guidance classifies applicants into 3 tiers, with each tier subject to increasing scrutiny. Federally insured depository institutions face the least scrutiny. Institutions that are not federally insured but are subject to federal prudential oversight receive additional scrutiny, and state or federally chartered institutions without federal insurance and without Fed-supervised holding companies are subject to the highest level of scrutiny. This tiered approach reflects the degree of regulatory oversight and information available about the institution. In November 2022, the Federal Reserve proposed to publicly disclose a quarterly list of institutions holding master accounts, increasing transparency in the application process. Policy considerations for fintech and cryptocurrency applicants. In evaluating fintech and cryptocurrency applicants, policymakers face a trade-off between promoting innovation and managing risk that may be insufficiently understood. Granting master accounts to innovative payment firms could reduce costs and expand options for consumers and merchants. However, the absence of a clear federal regulatory framework for payment systems leaves the Federal Reserve reliant on established banking rules and the guidelines of its own payment systems to manage risk. The current dual federal-state banking system can also limit federal oversight when state-chartered institutions lack federal deposit insurance. State-chartered institutions with federal insurance are subject to federal regulations similar to those for federally chartered institutions. Without statutory changes, however, the Federal Reserve may have limited ability to monitor or mitigate risks from institutions with master accounts that lack a primary federal regulator. This situation raises the question of whether non-traditional firms should gain access to valuable Federal Reserve services without incurring the regulatory costs typically imposed on traditional banks. Compared to non-crypto fintech firms, cryptocurrency institutions present additional risks, including cryptocurrency price volatility, fraud, regulatory uncertainty, and a series of recent failures among crypto firms. It is unclear whether the Federal Reserve has accelerated its review of non-traditional applications since the August guidance. Some experts have called for new legislation to clarify eligibility for master accounts and to require the Federal Reserve to expedite application processing. Notably, Title 58, Subtitle F of the National Defense Authorization Act for fiscal year 2023 requires the Federal Reserve to publish a quarterly list of institutions that have applied for, been rejected from, or been granted master accounts. Additionally, proposed legislation would require the Federal Reserve to grant master accounts to all depository institutions, while other proposals advocate restricting master accounts to traditional banks. Summary: Federal Reserve master accounts offer significant advantages for financial institutions, facilitating access to wholesale payment systems. However, the increasing applications from non-traditional firms, including fintech and cryptocurrency companies, present new challenges for eligibility, regulation, and financial stability. The Federal Reserve's updated guidance aims to balance the need for innovation with appropriate oversight, yet ongoing legislative efforts may further refine these standards and processes.